Lesson 14, marking to market in the field of options. Here, what you will learn here, how marking to market works with options, just it. As we have seen, options can be bought and short sold, but the risk profiles of the two positions are extremely different. In the field of futures, both the buyer and the writer of a contract are exposed to an unpredictable risk. In the field of options, it is not the same. The buyer pays a premium and knows that wherever the underlying goes, at worst he will lose that amount, nothing more than that. The seller collects the premium and knows that that will be his maximum possible profit, while his risk is always unpredictable. Therefore, only one of the two counterparties is exposed to a risk not defined a priori. The margin is a statistical risk measure that applies to leveraged positions that present a risk of insolvency. This situation in the world of options manifests itself only from the side of the short seller, who is therefore the only one required to pay the initial margin and to supplement any daily losses. Let's see how it works. When a short option is opened, the seller collects the premium but is required to deposit a guarantee margin called initial margin, exactly as it happens with futures, represented by the theoretical loss he would have to face in the event that the underlying moved against him in an amount equal to a percentage of expected maximum daily statistical movement. It is a measure of daily risk of abrupt unfavorable price movements. As it happens for futures, different margining systems can be applied in different countries and by different intermediaries. Here I will show you how it works on the Italian derivatives market. Until a few years ago, on options written on the FTSE MIB index, the margin interval was 10.25%, and that percentage changes from underlying to underlying. And it could change even on the same underlying, but it needed the risk management offices to take some time, decide how much to increase it, for how long, since when, and all the rest. It was the exchange that could decide whether and when to increase the interval of the margin and for how long. From June 1st, 2015, the method has changed. Today, the automatic risk management systems of the Italian clearinghouse monitor market trends and automatically calibrate the percentage of the margin interval according to market volatility. In this way, the systems intervene immediately in an autonomous way, raising the margin requests at the very moment in which the market shows itself to be more volatile, or reducing them when it is less volatile. This methodology is called MARS, margining system. With MARS, a further variant was introduced. While the previous method, called TIMS, took into consideration the risk of strategy tails alone, assuming that the risk could be nested exclusively in a strong directional movement of the underlying, now the system also determines 8 intermediate points to the overall payoff of the portfolio to check that the maximum risk does not occur for any reason within the margin range rather than outside it. Finally, the margin system takes into account the totality of the existing portfolio, including any combined positions on correlated instruments. And this actually happened also with the previous method, which, however, did not take into account what could happen in the midst of the strategy. That is, it looked only at the potential risk of the tails, of strong directional movements. How do margins work? At the opening of a position, single or combined, an initial margin is determined capable of effectively responding to the need to cover the statistical risk of the same position. The risk is determined based on a normal distribution model of returns. The margin obtained is the one obtained by applying 3.09 standard deviations to the average of the returns. That standard deviation values determines an interval that includes 99.98% of the cases. Furthermore, the calculation is made with reference to a holding period of 1 to 3 days. This means that historical returns on 1, 2, or 3 days are taken into consideration. The more precautionary, the greater of the three values is taken as a measure of risk. If the historical series of the underlying is shorter than 10 years, a 25% increase is applied to the initial margin as a further precautionary measure. The initial margin is considered a sufficient deposit to cope with any possible risk on a daily basis. Once the interval has been defined on a probabilistic basis at 3.09 standard deviation from the mean, it is statistically unlikely, in fact, historical data in hand, that the position may cause an uncovered risk. The initial margin is therefore the quantification of the loss that the short seller could suffer in the face of an unfavorable event of that magnitude. Let us suppose, for example, that we sell the call 20,000 points expiring March 2020 at 760 points, when the index is valued 19,700 points. And we assume that the margin range is 10-25% at the current volatility value. If the index rises by 10.25% from that value, it goes to 21,720. Against this value of the underlying, the call will take an indicative value of 2,200 points. It is just an estimate because the value, the real value, depends on the implicit volatility, which we cannot foretell. In face of such an increase in value, as short sellers of that call, we are losing 1,440 points, worth 2.5 euros each. It means 3,600 euros. Why is that? Because the value of the option now is 2,200. We short sold it for 760. We are potentially losing the difference. This is the margin we have to deposit when opening the uncovered position on the call above. The premium received from the sale, after all, amounting to 1,900 euros, is credited to us, so it represents an entry for us. The algebraic sum of the two values, 1,700, is the amount of money that moves from the ordinary account to the margin account. Adjustment of initial margin in closing and daily variation margins. At the close of each trading day, then, an adjustment is made to the value deposited to guarantee risk coverage based on the performance of the underlying and its volatility. Let's go through this step by step. Let's suppose that at the end of the day in which the short position was opened on the call 20,000 expiring March 2020, the index has risen, say, from 19,700 to 20,000 points, so that the call is now worth, an estimate, 900 points. Suppose further that the margin range is now 11%, 10.25 in the beginning, 11% now. Recalculating the initial margin range, considering an 11% increase on the current underlying price from 20,000 points, the current value of the underlying, we reach 22,200. At that price of the underlying, the call will be worth a price estimated around 2,700 points. This generates a theoretical loss of 1,940, 2,700 minus 760, the premium collected on short selling of that option. That is 4,850 euros, that is 1,250 more than the initial margin calculated at the time of opening the short position on the call. That amount of money must therefore be paid in addition to the initial margin. This is because the market has moved to an unfavorable position, and this leads to an increase in risk, which must be promptly neutralized to protect the safety of the market and all operators. In addition, we must also adjust the theoretical loss on the value of the option sold, which rose from 760 to 900 points. The loss of 140 points, 350 euros, must be paid immediately. This is the variation margin. and the mechanism that regulates the margins is called marking-to-market, as it happened with the futures. And once again, it is like closing and reopening positions every day when the market closes for the same price. In fact, the marking-to-market mechanism today is not applied only at the end of each day, but in real time throughout the day. Consequently, at all times, margins are adjusted in relation to the price of the underlying and its volatility, which affects the margin range. The performance of the margin account therefore reflects both the performance of the option price, or the combined price of all the options in the portfolio, and the volatility trend, which affects the margin interval. The initial margins, including the related daily and intraday adjustments, are only guarantee deposits, which remain tied until the positions are closed. Since, in fact, deposits aim to cover the risk of insolvency of the counterparty, when a transaction is closed, there is no longer any risk. Therefore, the margins no longer have any reasons to be applied. The only real profit or loss of a trade is represented by the daily summation of the variation margins, which can sometimes be negative and sometimes positive. So what matters is their algebraic sum. All of this is it happens in the same exact way as we have seen in case of futures. On options settled for cash at maturity, the result at expiration of a short transaction is therefore given by the final balance of the variation margins, which must coincide with the difference between the value of the option on expiry and the premium received at the time of short selling. Something similar happens with each day regulation. We look on a daily basis to the difference between the current price of the option and the price in the moment of short selling. In reference to the example in the previous slide, the variation margin is 140 points, which is equal to the difference between the option repurchase price, 900 points, and the price collected on short selling, 760 points. This is, therefore, the economic result that would be achieved by closing the position at the daily closing on the market. For all intents and purposes, the marking-to-market is equivalent to closing the existing positions every day at the closing of the market and reopening them immediately afterwards at the same conditions. In doing so, the risk always remains covered for a statistically sufficient percentage to eliminate any counterparty risk. And this is what margins are for. From everything reported in the previous slides, it is clear that in the marking-to-market mechanism, an implicit alarm system is activated when on the account of an operator that holds transactions at a loss, there is not sufficient funds to meet the requests for initial margin adjustments and the payment of negative variation margins. In such situations, in fact, an alert is sent to the operator called margin call. The intermediary warns the customer that he is in a debt situation with the market, which he must promptly resolve. The margin call can either be immediately closed by transferring money from another account, but the transfer has to be instantaneous, or otherwise the only possible way is one, to close open positions in whole or in part until we get back into the green side of the account. The balance in the account is again positive. Since the adjustments of the margins are calculated in closed markets, the closing of open positions aimed at the return of the margins can be carried out only the day after opening. If the customer does not arrange a situation in a few minutes, the intermediary is authorized to intervene directly. Some brokers, though, do not wait for the closing to intervene, preferring to act in advance. Since margins are calculated in real time, in fact, the intermediary always has the right to know if a customer is likely to go into margin call on a certain day. When the balance on a customer's account goes into the red before the end of the day, the intermediary intervenes immediately, asking the client to liquidate positions within a certain time, 10, 15, 30 minutes before the closing, and reserving the right to intervene directly in case of need beyond this time. Once some positions have been closed, the initial margin freed up accordingly is used to settle the pending variation margins. Since the size of the initial margin is statistically sufficient to cover almost any unfavorable market variation, it has been statistically demonstrated that the mark-to-market, if applied to the letter, of course, prevents almost any possible loss greater than the money used to open the trades. Insolvency manifests itself in a marginal percentage of situations which occur only in truly exceptional cases, with probabilities very close to zero. Obviously, once again, all this only applies if the mark-to-market mechanism is correctly applied by one's intermediary. Just to let you know, back in 2002-2003, a guy called me because back in 2001, due to the terroristic attacks to the Twin Towers in New York City, he got down 2 million and something euros, while on the account he only had 800,000. Why did this happen? Because the intermediary did not apply mark-to-market. For now, that's all. Thank you for your attention.